All right, let's start. So a couple of things. So I sent out about the pitch books. I knew on the industry side that was somewhat of a risk because PowerPoints as a team can add 10, 20 hours to a project. So I want to make it really clear. You're going to do this first one, which is good that you do one industry presentation. It is really, really important to the process. On the second and third rounds, we still need to do the industry analysis. You just don't need to do the presentation. You still need to do it. You still need to look and see what the issues are, those type of things. So the consumer discretion, you're probably wishing they started with the easier part and get it out of the way. But I saw the media and entertainment today. Theirs is in really good shape. They got a few things to clean up. They're going to do theirs next Tuesday at 4:15. If you want to come in and sit in on it, they're going to be in the FSC. We'll do them in the FSC. Paul's team is on Thursday. They'll do theirs next Thursday in the FSC. We might start in at 4:15, just we have technology all set up. And then the other three teams will do next Thursday night around 7:30. You can probably, if you want to practice, you can, or you can just sit and listen to the other team, and or maybe practice before you start and listen to the team after yours or whatever. I'm going to invite a lot of people, but I don't know who's going to join. So we'll see. This will be our first test case to see what we do. But so once we get this industry thing done, you can really focus in on your stock pitches. We're going to be talking a lot about the stock pitches here, financial analysis, valuation, relative valuation, those type of things. So you'll have a pretty good idea of what to do for the stock pitches.
Do you know what the recording situation looks like for the presentations? Because I know you wanted us to put it on LinkedIn.
Well, we'll record it in the FSC with the microphone. It may not be that fancy. I might bring an extra camcorder or something if anyone has some fancy equipment. I do have a nicer mic that I can use. I do have lapel mics that we could use, I guess. We'll see. I'll look into that. It may not be highest quality. The Zoom will be set up to capture the screen. So you'll have to make sure if you want your face, you have to make sure you're right in front of the camera so you can put your face in there. I can't put it on YouTube without your permission, so we'll have to decide if you want it on YouTube or private YouTube or whatever. But we will record it so you have it. I think the individual stock pictures are going to be probably more important because that we really can control what's on the screen. The media and entertainment went about 15 minutes. I know we said we want to be 10. We'll see how strict I am on that. We are a little bit limited with the Thursday night because we have three teams, and if they each take 25 minutes, that can use about most of our time. So we'll have to be careful on that. We definitely can't go way over, so we'll have to watch. So, but once we get past the this first round next week, we'll probably go ahead and run the screening model for your second two rounds, so you can have all of your stocks for the semester, and then we'll do the 3 rounds, or you'll do them in those sections. So we should be in pretty good shape on that. The second thing to think about, which is something we've been talking about with the investment society, is especially for the second and third rounds, we got some eager freshmen. I mean, really eager freshmen and sophomores. So what we want to do is give you a mentee, and you don't have to take one, but it would be really good. A couple of benefits. First, it looks good on your resume that you're a mentor or a leader or teaching someone. Second off, they can do a lot of work for you. You can't, I don't want the labor department coming after me, but you can assign them stuff to do to help you find stuff. So I'm assuming you all want someone, but if you don't want to do that, if you think it might be too much, just let me know. But we're going to try to line you up. Joshua's already found a good group of students that look like they might want to do that. So you each get someone, like if you want to run a special analysis, you could say, hey, try this, see how this looks, stuff like that. So we're working on that. And then the last thing is the CFA Research Challenge. They just announced that the deadline to sign up is November. So we had a team last year. We really led that team very strongly. They did really, really well, ranked really, really high. He can't compete again. So he's been canceled for the rest of his life. He can never do CFA Research Challenge again. But what I'm thinking is I have to look at the rules, but I think it'd be okay that if a team wants to do, it doesn't be your team, but if a team of students from this class, we could probably find a way to count some of that as part of your class in the spring, because there's a lot of overlap. You're doing the exact same thing in the CFA research challenge that you do in this class, right? Read it. It feels really similar. So it kind of depends on what company you get. We get a company that fits well. We could certainly make that part of the spring, so you get kind of a little bit of double, because the heavy work is January, February, which is right at the beginning of this semester, this class. So it'd be nice if you could double dip and use that. So think about that. It does look good on the resume. I don't know if you brought it up in your interviews, Reed, but I mean, it's pretty impressive to do that, have that on your resume. So we'll see. We usually pull a team from this class, but I couldn't get any volunteers except for Reed and Jonathan last semester. So we pulled some freshmen in and a cybersecurity major, and they still did really, really well. So it works. We have some tricks that I've learned over time that work pretty well. One thing you'll notice is most teams have buy recommendations, and it's something you'll figure out really quick that you can't do is get enamored with your company. And a lot of students, they just feel like they're supposed to sell their company, but that's not your job. Your job is not to sell your company. Your job is to decide whether it's a good investment or bad investment. I think one of the reasons they did well is that they didn't come in with just a strong buy. And a team that y'all beat, I remember 2 years ago, I knew our team was going to win because Rice had a buy and we had a sell, and you could just tell they were promoting the company and not doing independent objective analysis. So sometimes you almost want to do a sell just so you stand out. So, all right. So what we're going to do is work on financial analysis tonight and Tuesday night. I've given you the files to do it. I've heard some of y'all saying I've never done financial analysis. If you're not good at financial analysis, oh, you better get good at it. This is like 80% of finance right here. This is a big chunk of it. I've given you the template. So who can give me the template? Two big questions. What were the two big questions?
Viability and growth.
Short-term viability, are they going to be in business? So you got to make sure they're not going to go out of business. And you've done the second one.
Growth.
Long-term growth. Growth is what we want. So you're making the argument for growth. So under short-term viability, what are the two things we look at there?
Solvency and liquidity.
Yeah, solvency and liquidity. And then long-term growth. Turnover margin. So it's a key. And then we bring it all together with ROE. So those are the things we're going to look at. So that applies for every company. You'll see next semester, those that continue next semester with banks, insurance companies, turnover and margins are very different for them. And liquidity is different as well. But those categories, liquidity, solvency, turnover, margin, apply to all industries. For liquidity, we're going to focus on a couple of things. Working capital, we're going to spend some time tonight on because it's a tough one. And then we're going to look at their cash from operation and use of free cash flow. If you listen to business breakdown, they talk a lot about working capital. They talk a lot about CapEx, capital expenditures. How does this company spend its money? Pretty important stuff. Solvency is usually pretty simple. In fact, on solvency, we'll run the numbers, we'll look at them, but essentially, the rating agencies have done a lot more work than you have. So if it's rated single A, double A, I think Walmart's rated double A. I mean, I'm not that worried about it. I had a student doing Johnson & Johnson, AAA rated company. Yeah, if he comes out and say this firm's in trouble, he probably did his analysis incorrectly. So ratings are pretty good, but we'll look at the obvious things. And then we'll conclude with the quality earnings. So let's look at working capital. Working capital is not current assets. So working capital, you have working capital assets, working capital liabilities directly tied to operations. So working capital assets, inventories, receivables, and other liabilities, accounts payable, accrueds, and unearned revenue. If you look in the file that I gave you, I'm doing Walmart. There's a section down here that handles that, lines 30 through 33. Here's your working capital assets, your working capital liabilities. And which is more liquid, a negative number or a positive number? Negative is better. Oh, you're in my class too, man. So you did this. You remember what company you did? Oh, you did an international company. So negative is actually better. I know the accountants say, no, that's terrible, but this is actually better. You actually like their working liabilities to be higher than the assets. Be real careful when you're looking at it. Some students get confused and look at the CAGR. We're not asking if the CAGR is positive or negative. We're looking to see if the actual dollars are. If the dollars are negative, if it's actually a source of cash, you want a high CAGR. If it's a use of cash, what do you want? You want a very low or even negative CAGR. All right. So is the CAGR high or low, good or bad? Depends if it's a source or use. Okay. So we prefer liabilities to be greater than the assets on working capital. Why? Because the assets don't earn you anything. Accounts receivable, you don't usually get paid interest on that. Inventories are sitting in the warehouse making you nothing. There's zero returning assets. How much do you want in zero returning assets in your portfolio? I don't want any. I've had some, but I don't want any. How many zero costing liabilities do you want? Bring them on. I'll take them. What do you got? If you want to loan me money, zero, USA loans me money, 0% interest every year, and then pays me a 1.5% bonus at the end of the year. It's like, great, I love it.
How do you get 0% interest, Professor? That's interesting.
Then my credit card, right? I borrow money for 45 days, I'll pay off the balance, no interest. And at the end of the year, they pay me 1.5%. It's really stupid of them, but they do it. Why? I don't know. They get the exchange fee, but they don't make money on me, but it's great for me, right? It'd be stupid for me to use a debit card. It'd be stupid for me to write a check or use cash because they're loaning me money interest free. So that's essentially what these liabilities are. We prefer to be negative. Let me show you an example of this. This is AutoZone. This is from Business Breakdown. This it may be a little loud. We'll see.
Visit. And I think that is still a really big barrier to entry in this industry. So there are two ways really to drive a high return on capital. It's either to have wide margins or to have high capital turnover. Most of the most reputable retailers tend to have low margins and high turnover. And this is somewhat of the...
Right. So he's talking turnover and margin, but he's going to talk, so one thing to be really cautious on liquidity. Working capital, there's a strong connection between working capital and turnover. Because how do you control your working capital? Do you increase inventory turnover or reduce it? What would you want to do? Do you like higher inventory turn or lower inventory turn? Higher. What happens when you increase your inventory turn to your liquidity? It improves. So there's so you have better turnover, you have better liquidity. So they're combining these two in this discussion because they're talking about most retailers like Walmart, Costco, they have really high turnover, but thin margins. Here's AutoZone with really low turnover and wide margins. And so he's going to say, well, that must crush their working capital. Because what is AutoZone? Whatever part you need for your car, they better have it. Which means I got these massive inventories. That sounds horrible. He's going to say, yeah, but they have negative working capital. You're like, how in the world do you accomplish that? How do you have high inventory and have negative working capital? Let's see if we can figure out the mystery. So you can see why I love Business Breakdown because they explain these companies so well. If you want to understand, he's talking about an economic moat for AutoZone. I don't recommend AutoZone. Diana, I don't know if that comes up on y'all's AutoZone. AutoZone to me is almost a staple and not a discretionary, right? Because AutoZone does well if we don't buy new cars. They love used cars. But let's see, how do they have an economic moat when they have this huge disadvantage? They have wide margins, that's great, but they have this working capital problem. So let's see what he says they do. And he's got a great accent, so he must be smart. He must know what he's talking about.
The opposite approach. The inventory turnover here is quite low. And the way they do it in such a capital efficient way seems truly unique to the business.
All right, so the inventory turnover is low. That sounds terrible, right? You're about to hear a firm that has terrible working capital. You say, nope, they're actually really good at it. See if y'all can figure out how they're good at it.
Can you spend some time explaining that? That's exactly the right characterization. This specialty retail is almost inverse to that general retail model of stack it high, sell it cheap, sell it frequently. It's a real barrier to entry. that really is something that needs to hit home to the listeners. Having this huge assortment available whenever customers need it is hard to do in terms of merchandising and supplying. It's great because it's long-lived inventory. It generally doesn't go out of stock. You don't have obsolescence of that inventory. So you can afford that wide margin through.
So they don't have to worry about obsolescence, so that gives them an advantage, right? This isn't HEB stacking up oranges for the next 7 months or something. So if you need a 2018 whatever car part, it's going to be so this, it doesn't go out of doesn't spoil or whatever they can. So they have an advantage; they can hold the inventory.
Exceptional customer service, which we touched on, and then you can drive great efficiencies through the store level, great efficiencies as you consolidate and grow, improving that operating margin, driving up that ROIC from that side of things. The capital employed side, there is one other thing that they've done incredibly well, which is to maintain a zero or almost, it has been negative actually for the last 10 years, working capital position.
Okay, then accountants are going, wait, what did he just say? So he said negative working capital. Does that sound like a good thing or a bad thing? The way he's talking. He's talking about this is their economic moat, is negative working capital with big inventories. So you're like, how did it's curiosity. How can you possibly do that, right? It sounds impossible. Let's see how anybody know how they do it? How can you have big inventories and have negative working capital? Any guesses, Reed?
You have a really long payment terms with your supplier.
Accounts payable, right, exactly. But why would their vendors allow them to do that?
Because they're such a big firm, they kind of have to, you want to work with them.
Yeah, so how do the vendors, because the vendors go out of business, right? They don't get any money. So you're exactly right, but how do the vendors? So I mean, if you can pull this off, you've done something pretty incredible. They've pulled it off. So now you're asking how to do it, because remember, economic mode is what? They're doing something that gives them a huge advantage that others can't copy. All right. So how are they doing something that others can't copy? So it's a huge advantage. Seems too good to be true.
And so the inventory in the business is actually very high. The physical in-store stock and in the distribution centers is very high, very wide-ranging, luckily low obsolescence. But their net working capital, due to the high level of payables, is negative by about 10 days of sales outstanding, negative working capital position. Which means as you grow, when you're doing that store level maths that I talked about earlier, you don't need to stock the store with cash. You put physical items into it, but you don't need to include them in your capital calculation because you're not actually outlaying the cash for them. And obviously receivables, there's very, very low levels of receivables on the balance sheet because most customers pay at point of sale. Given the amount of times inventory turn.
All right. So I don't know if they say in here, but so the question is, for the economic moat, their vendors have to allow them to do this. It sounds like a real problem for the vendors because their vendors are all going to be out of business because they're not getting paid. So any guesses what the vendors are doing? How can vendors get their cash when AutoZone's not paying them?
They sell the good.
They what do you call it? Yeah, are they? I've forgotten the word. I can't remember the word. Factor the receivables. Thank you. It's like, man, I'm getting old age disease here, but they factor the receivables. How can you factor the receivables? AutoZone better be what? Better be a very high quality firm that's reliable, that's going to be there, not going to go out of business. That's what AutoZone has. So they're able to have these huge inventories. They pay their vendors really slow. The vendors don't mind because AutoZone's such a highly respected firm. The banks won't let them factor the receivables. And O'Reilly copy that. And the others copy that, maybe or maybe not, but it's an advantage for them. So I won't play the rest of it, but it's an interesting model, but it certainly reflects what we're talking about here of managing this equation where they're specifically managing it. They have one working capital asset that's a problem for them. It's inventory, but it's part of their business model. They want their customers, when they show up, the products there. And what else does AutoZone do? You need wipers. You don't know what kind of wipers you need for your car. They're going to help you with that. What else will they do? Put them on for you, right? So high quality service. So you don't mind paying a little extra for AutoZone because they can do all that. You know they're going to have the part there, all these things that they do, and then they manage it on the trade payable side. So you see why I like business breakdown. They really get down to the essence of this business. What are their advantages? So you're looking for a negative number there, and then the CAGR depends on whether or not it's a source or a use. I say if it's a negative, your assets are lower than the liabilities on the working capital side. That's actually a source of cash. You don't see that frequently, but you see it for Walmart and Costco. Costco, maybe not all the time. If you do see it with some of these firms that have, you know, the ability to sell stuff before they pay their vendors. Their working capital actually produces cash.
2 or 3 years ago, Tesla had a battery day where Elon Musk was talking about negative working capital, almost rapturous. Looking forward to all the growth that negative working capital means free capital has been come in.
Oh, really? I don't know how he would pull that off. That'd be interesting. Wow, that was,
I don't know whether it's a matter of customers paying stars.
yeah, probably before they even built. Yeah, you could do that. I mean, that's, you know, I'm not a big fan of airlines because horrible margins, terrible bad years when they're bad, heavy capital requirements, but they do have one thing going for them is never negative working capital because of all that unearned revenue they get. And it's huge, right? It's a big source of free capital for them. All right, so there you're looking at just the trend over time. The one thing I've done for you on this page is down below, starting at line 54. I give you the details on it. So if you're trying to figure out, you might see just all of a sudden something jumped. So I saw this with, I think it was Walgreens a few years ago, or maybe in CVS, that their inventories just jumped dramatically at the end of 1 year. Okay, what happened? Well, that was back when Theraflu, everybody's worried about the flu season, so they stocked up a bunch. So it was one of those things that hit really hard, and then it went away the next year. So sometimes what you can do is if you see a big jump, go look at your quarterly statement for the next quarter and just see maybe it was a one-time thing and it jumped back down. So you're trying to see, was it a one-time thing or something shift in the business? You know that if you go to the annual report, the accountants have to tell you why something jumped like that. So you can go find that. So what I usually do is go find it on the balance sheet, get the exact title, then I do a search on that title. Or if you use Capital IQ, I don't know if y'all got into Capital IQ, they have this thing where they have all these links. If you click on the link, it takes you right to the footnote. You don't have to go find it yourself. So Capital IQ, the online version, it's pretty cool. You want to say, hey, why did accounts payable move like that? You click on that, it takes you all the footnotes. It's really pretty cool. So down here with Walmart, first of all, inventories is their biggest item on the asset side. Payables is the biggest item on the liability side. So you really can just focus on those two. I don't know why Walmart has receivables. Maybe Visa, MasterCard receivables or the banks, something while they're waiting. Maybe there's a clearing that goes on with that. I sure don't owe Walmart any money, but it's a pretty small number. Sometimes you'll see an other number jump, and sometimes those other numbers are not working capital. I've tried my best to take them out. One thing I took out was deferred taxes. I don't consider deferred taxes to be working capital items, so I've taken those out. Occasionally something else will get in there. And the most irritating is you see other jumps. So you go to the annual report and you drill down and you find the other items, and there's 6 other items. And guess what the largest of the 6 other items is? It's called other. So the largest item is other under other. And you're like, how much further can we drill down? And you can't tell. With Walmart, they did some kind of subsidiary trade or something that caused this big number, and I just gave up trying to figure it out. The footnote, I read the footnote and it made no sense to me at all. So I finally just said it was a one-time thing, not a big deal. I'm not going to worry about it. How do you write it up? You can see you don't have to write anything, but if you want to look at it, with Walmart, I said working capital assets are less than their liabilities. So working capital is a source of capital. That's good for them. Let me look at the trend. It's growing pretty well. They're not getting worse at it. They're getting better at it. They probably will get better at it with AI and robotics and warehousing. I'm sure they have some warehouses. I should show you the video of these warehouses with no humans in them. It's just absolutely amazing. The fulfillment now is just getting crazy. So I'm sure they're going to get better and better at it. I don't know how they do curbside. I haven't I was talking to Britta at HEB, I think curbside, they're still figuring that out. They don't have robotics doing that. Have any of y'all used curbside? Does it seem like it's a good process?
Or for women.
Either one.
Saves you a little bit of time.
No, man, for them, not for you.
Yeah.
So
Okay.
they're doing stuff that I'm not sure is making them more, they may be just experimenting. So, you know, you kind of just kind of ask the question, how that's going to help them on the working capital side. I have a graph. I like to do working capital to revenue. I like to divide by revenue mainly because I divide by cash from operations. I don't like to divide by numbers that can be negative or can shrink down. So revenue is a nice, it grows with the business and it's a nice positive number. Just to get a sense, is this problem getting better or worse? Or are they getting better? So here you can see it's gotten much better. Because you want a negative number, right? It's gotten much better over time. I don't know what happened in 2020. That was the thing in 2020 versus 2020. Something bizarre happened. It had nothing to do with the operations. It was some subsidiary transaction that they did. But they are getting better at it, which to me is pretty impressive. You got a firm that's already has an economic moat when it comes to working capital, and they're getting better at it. That's what we talked with the economic moat. If you can take an economic moat and improve it, you're really setting yourself up for a huge advantage. All right, so yeah, I don't know if y'all probably haven't pulled the numbers yet for your firms, but it's set up. This file is set up in Capital IQ. So if you pull on Cap IQ, so I have all of your data for your firm. There's a print page 1, which is all of your firm's data. We'll walk through this as we go through it. The second page is all the graphs for your firm. And then I set this one up that you can compare to 2 firms. Here I've got Walmart compared to Costco and Target. So I have that also set up. Here's the Capital IQ data. Here I have it copy and paste it as data so that I don't have to worry about Capital IQ. But if you use the Capital IQ, it bring this data in. And remember, there's a video at the very front that shows you how to do everything. So just follow that. So we'll keep walking through there, but there's the lines for working capital. There's lines 54 through 60 that gives you the detail, and then lines 30 through 33 that gives you the actual numbers. Most of you, your working capital is going to be a use of capital. So that's not a problem. I mean, it's normal for most businesses. If it's a use, you like it to grow more slowly than the business. You'd like them to be getting more efficient. Young startup firms can sometimes have problems. I was working with a CFO of a firm that had a software. It was like it was an interesting software. They had software to help firms do internal moves, how they coordinate desks and moves all internal to the firm. It was doing really well. They're selling really fast. But their contract said, you don't have to pay us until we perfect the software. And their whole sales force was out there selling software. Guess what they weren't doing? They weren't fixing it. So they weren't getting, their receivables were growing. And the CFO said, you guys better stop selling and go back and fix the problems or we're going out of business. It was a working capital nightmare. He's like, we have no cash. I can't. And the workers are like, no, we got to sell. I got to sell. Well, I have no money to pay your sales commissions. So you can keep selling, but we're not paying you until you go back and fix the software. So you got to watch working capital with younger companies because they can be focused on the wrong kind of things. They can build up their inventory too fast, those type of things that can cause serious liquidity problems. All right, any questions on working capital? Are you going to put this in your presentation? Probably not unless AutoZone. I would probably talk about AutoZone. If it's a key aspect of their business that they're doing something, if Walmart has some new inventory process that's going to make them much more efficient, I probably would put it in the presentation. You need to at least look at it and see if there's anything going on unusual with that. All right, the second thing on free cash flow. So free cash flow is available to management to do what? Well, they can pay dividends. you're producing cash flow over and above what you need to maintain the business. You can pay dividends, you can buy back stock, or you can pay down debt. And so I've given you a chart on print page 2 that shows those cash flows. So above the line is the cash outflow, below the line is cash inflow. So if you look at Walmart, their dividends are ridiculously predictable. Walmart likes to pay them, and they essentially like to go up 1 penny every year, and just very, very constant dividend. All right, we're going to talk about the dividend discount model. The dividend discount model assumes what? That their dividends reflect their free cash flow. Does Walmart pay out their free cash flow every year? Doesn't look like it, right? So their dividends is more of a signaling kind of real steady kind of thing, really doesn't reflect the growth in the business at all. The stock buybacks have been pretty bouncy. Some big years, some smaller years. So kind of all over the place. I don't know if any of you are going to recommend Costco. I love Costco. Costco doesn't do stock buybacks. They just do a massive dividend every 5 years or so, which is really, really massive. It looks like a stock buyback. Why they do a dividend instead of stock buyback, who knows? But I mean, look at this year right here. They bought back $10 billion of their stock. Does a firm having liquidity problems buy $10 billion of its stock back? Probably not. Right on the debt side, they've been paying down their debt pretty consistently over time. They might say, well, obviously you're going to pay down their debt, but this is the net pay down. So what most firms do is they roll the debt over. So if you got $3 billion in debt and it comes due, you borrow $3 billion, pay it off, and you just keep rolling it. So they're actually reducing their debt, paying it down, except for 1 year. Any year stand out? You can't see it because the years went away. So 2018. So 2018, they borrowed a lot of money. What is probably the most likely case there? Probably an acquisition. You see a big borrowing like that, probably an acquisition. Some firms are actually borrowing money to buy stock back. You don't see a large stock buyback there relative to the previous years. So there they bought Flipkart in India, which I think is actually starting to work pretty well for them. So that was their Flipkart purchase. Walmart doesn't do a lot of acquisitions, but they do some. They did, was it Jet? What was that thing called? That internet firm they bought. I forget the name of it. They did that, but I don't think there's a lot of debt involved. I don't think that was a big purchase, but they did buy Flipkart. So acquisitions is extremely important. I put the media and entertainment. They have a whole slide just on acquisitions because that's huge for the industry. So you have to think about that. There are some industries that merger and acquisitions are huge. Retail, maybe not as much, but there is some of that going on. Walmart was doing it for international expansion. So you can explain that one away. They borrowed some money in 2022. Don't know exactly why. They have been cutting back here recently. But even in 2024, the net out of the pocket was about $13 billion, $12 billion. That's a pretty hefty outflow. Obviously not a major liquidity issue for sending that kind of money out the door. So they're obviously producing free cash flow. But what else can you do with free cash flow? You do CapEx, right? You can reinvest in the firm. You do need to ask the question about CapEx. CapEx is always an important question. If you listen to business breakdown, that's always one of the questions. How does this firm manage its capital expenditures? What does it invest in? Because what don't you want? You don't want a CEO who's building trophy assets, right? Doing stuff. No, we had that. Oh man, I shouldn't tell you USA's history, but we had that at USA. When I started USA, we bought some horrible assets because we had a CEO who was going to retire and he wanted his names on stuff. Like, oh my word, horrible assets. Probably the worst one. I shouldn't tell you all this with Mozone in here, but oh my word. If you buy a theme park and then you sell it a few years later, and when you sell it, you have to write a check. That's probably not a good sign, is it? How many of y'all want to buy something and when you sell it, you have to pay the buyer? To get off your hands. So that wasn't a really good investment. So we were doing something, you don't want that. What is this firm? And so look at that CapEx line and ask, what are they actually buying? Is it bouncing around? Is Walmart building new stores? Are they acquiring other firms? Are they enhancing? You know, a lot of Walmart's money is refurbishing existing stores. That's a lot of money. They're putting a lot of new technology into the stores and stuff like that. That's a lot of money. You want to know that because you want to understand what the payback on that is. Is I can get them more foot traffic. They may be doing more technology because they're going to try to be picking up some more advertising, increasing their advertising revenue. So they need to add some enhancements there. But what is the firm doing with CapEx? So I gave you a CapEx chart. It just gives you the numbers. See if I can Control Z out of it. So again, I do CapEx to revenue. So Walmart has actually been doing quite a bit of CapEx, but their square footage has not been changing much at all. So that's not new stores. So it kind of raises the question, what is Walmart doing with the CapEx? Remember when we talked about economic moats, that if you have economic moats, you want to reinvest into the moat and strengthen it. So, you know, you have to ask, what is Walmart's economic moat? Where are they putting their money? It can be tough to figure out exactly where that CapEx is going, but you can go through the annual report and try to figure out what it is that they're spending their money on. Business Breakdown does an exceptional job on that. One of the first business breakdowns was Cinnabon, and Cinnabon, Kat Cole, she did a great job of talking about their CapEx and how they look at it and just their analysis on where they put their money. So look at that. If it's pretty flat, that's fine. If it's coming down, it is possible that the reason they're doing large stock buybacks and large dividends is because they don't have anything to reinvest in. They don't have good CapEx. If you see the CapEx is coming down, they don't know where to put their money. That may be why they're spending back. With Walmart, you can see they're sending a lot of money to their investors and they're increasing their CapEx. What does it say about their free cash flow? It must be pretty solid if they're doing those things. And then what's the last thing you can do? There's only one left. What is Apple doing? Microsoft doing? You just hold on to it, right? You just have it sitting in cash. What's Apple going to do with all that cash? You know, they're buying firms, right? You can do that. Microsoft buying firms, Google buying firms. They got a lot of cash that's sitting there. You know, in your corporate finance class, if you have good reinvestments and positive net present value projects, you reinvest in the firm. If you don't, what do? You send it back to the investors. But if you're Apple or Google, you don't want to send it back to investors because then you look like a dividend stock, which is kind of old economy. So you don't want to do that. So you just sit on it in cash and eventually you'll figure out something to do with it. But holding in cash, this one you got to be careful because cash is in more lines than just the cash line. If you look at Apple, so their cash looks like it's $65 billion. But they have another 91 billion sitting in short-term investments. That's like cash equivalents. So they really have $150 billion in cash. So you have to look at more lines than just the cash line. Mainly because the yield curve was pretty steep a few years ago. So they started going out to 1 and 2 years, sitting $150 billion in cash. You might as well go out 2 years and pick up a little extra yield. But once you go out more than a year, it moves from cash and short-term, I mean, cash from current assets to investments, but still pretty big number. 160, 170 billion. Now they're 150 billion. I mean, these are massive, massive numbers. So that's the evidence of free cash flow. You can bring free cash flow in. I think CapEx has a free cash flow number in there. I don't want to get into and the calculation issues, so Bloomberg has one you can bring in. And I just noticed this last weekend. Look at this. I think it's on the cash flow statement. Let's see. Look at what Yahoo just added. Look at that last line. Rajan, have you looked at their free cash flow calculation? They just added free cash flow to their, I hadn't noticed it either in my EMBA class this weekend. Oh, there's free cash flow right there. Oh, yeah, they just added free cash flow. So I don't know how to calculate, you can back in and see if they use, Rajan's formula is the right one, but who knows what one they're using. I don't know what Bloomberg uses, but, so you can see, I don't know how they come up with the tax rate and all of that kind of stuff, but there's Apple's free cash flow, a pretty massive number, 100 something billion dollars. Pretty massive number every year, and yet they're paying $15 billion. You have $100 billion in free cash flow and you're paying a $15 billion dividend. So what does that tell you about the dividend discount model? It's not going to give you a good valuation. I like how the motor end says, yeah, the dividend discount model works for about 5% of the companies, because obviously they got a lot more free cash flow they're paying in dividends. So yeah, they are buying some stock backs. In fact, you're doing quite a bit of stock repurchases there, which is a little bit of a new thing for them at those levels. So anyway, so you do have some information in Yahoo Finance. You can probably get that number out of Capital IQ. You can definitely get it out of Bloomberg. So we'll see when we do valuation. I do like to use free cash flow for valuation instead of dividends, just because if your firm doesn't pay dividends, at least gives you a number you can use.
Question.
Oh,
Yeah.
sorry.
So when you're talking about paying it in advance,
No, it's what you pay down debt. So you borrow $3 billion. I mean, you could pay it off early, but usually it matures. What most firms do is they borrow, if $3 billion matures, you borrow $3 billion, pay it off, and you're $3 billion. So what they do is when it matures, instead of borrowing it, they just pay it down. It matures and they pay it off. You can pay it early, right? You may have callable debt that you can pay early. You can buy back your debt at market value, but most firms are going to let the debt mature. They don't need more debt, then they'll just pay it off. If you have free cash flow, if you don't pay free cash flow, you borrow again. I'm not asking you debt's repayment schedules, but that could be an issue for you if your firm has a lot of debt. You can get those out of the annual report that shows you how much debt is due in the next 2 years, next 5 years, next 10 years, those kind of things. So that is an annual. If your firm has a lot of debt and you're worried that there's a lot of it going to be paid all at one time, you could certainly look through that. All right. So do an assessment of your firm's working capital and then get a sense of how liquid they are, looking at evidence that they're producing some free cash flows. If they're not producing free cash flow because they're a younger firm and they're growing really fast and the money's all getting eaten up, that's fine, but you gotta have to figure out at what point, and you can't just keep borrowing forever and ever and ever. So at what point they become capital sufficient that they can take care of their capital needs internally with that and go out. So if they're borrowing a lot of money, issuing a lot of stock, you do need to start thinking, first of all, what's the use of that cash? Is it working capital? What's driving that? Can they control that? If you're doing a larger, more mature firm, that's typically not going to be an issue. But for younger, fast-growing firms, yeah, that can be make or break, right? There are some great firms that go out of business because they can't handle this working capital side. They just can't get enough money to fund the business. They're just so illiquid. And questions on liquidity? All right, on debt, you obviously have the credit ratings times interest earned. I'm not a huge fan of that ratio, but you can look at it as essentially looking at your earnings for interest and taxes divided by your interest expense. Just got to get a sense if you're covering your interest pretty well. I put that ratio in your report. Here's times interest earned. On these type of charts, you can, if you want to, take out some of the extremes and just compare them to the industry median. Is higher better or lower better here? Higher is better. And what is Walmart's number? So some students say it's like 19%, but it's not 19%, is it? What is it? That's not a percent, is it? Is that
So
19 times, right? That's students say it's 20%. No, 20% would be horrible because that's 0.2. So my general rule of thumb that I've always used is if it's above 10, I don't worry about it. So, I don't worry about a firm that's 30 and now they're 27. It's like, big deal. All right. If it falls below 10 and the trend's coming down, I'm starting to get worried. If it gets down to 2, you're really in dangerous territory. So above 10 and it's doing okay. I mean, if it's above 10, it's coming down like that, you may be a little concerned. It does fluctuate around because you're using EBITs, so it's, firms' earnings do tend to fluctuate some, so the ratio can fluctuate. But if it goes from 30 to 22 to 27 to 17 to 22, it's well above 10, consistently above 10. I'm not worried about it. So it's a quick look just to make sure. So that's the question to ask. Can they handle their debt? The second question is, do they have too much debt, their level of debt? So one is about the ability to pay the debt. The second one is, do they have too much debt? A lot of times you'll see debt to equity. I think you see that a lot, especially in accounting classes. I don't know anyone at Victory Capital uses debt to equity. Debt to equity doesn't make, if you're buying a house, I bet the bank doesn't ask you what your net worth is. What are they probably going to ask you?
what's your credit score?
Well, but what else? Your net income, right? They're probably, because most people buying a house, what is the net worth? Probably,
Negative.
$20,000 or something. And it's pretty small, but they want to know the income. So would you sell a $500,000 house to someone with $20,000 net worth if their net income was $350,000? Yeah, probably so. So we tend to do that, and you'll see in practice, we tend to look at debt to earnings more than we look at debt to equity. The other problem you have with debt to equity, there's so many firms with negative equity here. This consumer discretionary, you guys, again, y'all gonna notice it with the restaurants. McDonald's, Papa John's, Starbucks, maybe. There's 5 or 6 of them with negative net worth because they bought so much of their stock back. So you can't do debt to equity because they don't have any equity. So debt to EBITDA is a good number to use. You have the question we total and net. Total doesn't subtract cash out, net does. So for a firm like Apple, you can actually get a negative number because they have more cash than debt. Obviously, if they have more cash than debt, you're not really worried about their debt. Not an issue. So I give you the ratio there. Look at it, make sure it's not out of line with the industry. Here I have Walmart. It's high because of that Flipkart purchase, but it has been coming back down, but they are high versus their industry. Might be a little bit concerned, but then I look at their credit ratings, it's AA. So, okay, maybe not a serious issue, but they do have more debt than the typical company. And it is higher than where it was prior to the Flipkart purchase. And then for quality of earnings, I have something, this gets back to that Howard book of, is there something funny going on between net income and CFO? So I just have this chart that builds that up and just looking at it to see if you see any unusual transactions. So the blue line, the blue bar is net income. Everything else is the adjustment from net income to CFO, just to see if there's some unusual activity. So the 2 things I'm mainly focusing on are working capital and other. Working capital can kind of bounce up and down, but what I'm worried about is a trend that is negative for several years and getting bigger and bigger and bigger. Their inventories are becoming obsolete. The receivables aren't getting paid off. I don't see that with Walmart. And then other, you just have to look it up in any report to see what that other is, but it's a pretty consistent number. I don't think they're playing with the books, but I'll look at it. So anyway, I just look at it, see if there's anything strange going on. Usually what you'll see 1 year where something really big happens, and I usually like to go see what happened. Maybe they funded their pension plan. A lot of times you'll see a big adjustment for realized gains. Those aren't really a huge issue. If you're a finance major, you need to understand how realized gains flow through the cash from operations. I don't know if y'all can explain that. That could be a question y'all could get. I think if someone's asking you about accounting questions that you said. Yeah, so yeah, realized gains. So if y'all know how that works through, right? If they sell a subsidiary, that goes through the investment cash flow. But if there's a gain, that goes in net income, but the gain's in investment cash flows, so when you bring income over, you got the gain in there twice, you gotta subtract it out of the cash from operations. That looks bad, right? It's a big number, but it's really not that big of a deal. It's just fixing the cash from operations. So sometimes you can have a really big other, and it's really not that big of a deal. Just like you can explain it, but I'm looking at that. And then you're looking at credit ratings. So at the bottom of this print page 1, I have their credit ratings. AA. I'm not really worried about this firm. Pretty good. My guess is Moody's and S&P have spent more time on your company than you have. So probably a pretty good indication. They're really good at what they do. I know 2008 was terrible, but it wasn't on corporate debt. It was on the structured debt. So they're pretty good at that. And then I give you the Bloomberg default, which I really, really like. We use that in our screening model. Very, very low for Walmart. So I think Walmart's safe. They do have a little bit of debt that's risen up. Maybe a little bit of concern, but it's gotten a little bit back. It's gotten back, at least it's come back down. And they're very, very low risk versus the industry. All right. Everybody feel good on solvency and liquidity? So let's say you're in an interview question. And say, how would you assess a company? Could you, off the top of your head, do what we just did?
Yeah.
Okay. I remember students always say, Professor, do you have to memorize this? And what do I say? No, don't memorize it, just know it. This is the stuff, this is the kind of stuff off the top of your head. So think about this, not for the class. Think about you're in an interview and they ask you, how would you analyze a company? Make sure you have a template. If you don't like this template, come with your own. I think this one's pretty decent. How would you go through a company? Well, first, I want to see if they're going to be in business in 5 years. I want to look at their liquidity and solvency. Liquidity, man, are they managing their working capital? How's their inventory turn? How's their receivable turn? Is it a use of cash? If it's a use, is it getting, are you controlling it? I want to look at, they have good free cash flow. Are they buying back their stock, paying dividends, keeping their debt level low? If you can say it off the top of your head without going, like that, right? That's the bad sign. You can just roll it off your tongue without even thinking about it. That's what you got to get. Because this is when you know in your right profession. Because I tell students, you know, you're going to be doing this the next 50 years of your life. That depresses you. You maybe I get pretty excited. I mean, I see a company like listening to that AutoZone one and I'm, wow, that's pretty interesting. Yeah, that's a pretty good strategy. How'd they get this? That excites you. That's what you're doing. If that doesn't excite you, it doesn't mean you shouldn't be in finance. But security analysis, we do a lot of this security analysis. There are corporate jobs where you don't do this side, you do other things. But yeah, you're kind of a forensic accountant, forensic finance person. You want to understand what does this company do that's different than everybody else, and can I see it in the numbers? And when you see a strange number, you can't rest until you find that out. That's what this job's all about. So if you enjoy that, but you got to have the template. You got to know where to jump in. So I'm trying to give you a template. All right, let's talk about growth prospects. So this is really the most important part. So when you hear business breakdown, this is where they're going to talk the most. It's the growth in the business and it's the profitability. Turnover is the growth in the business. It's that top line revenue growth. How are they growing that? Is that growing? Where's that growth coming from? Where are they in their life cycle? Who's the demographics? I love business breakdown. Always talks about the total available market. If everybody that could buy this product were to buy, how big is the market? How big is it today? How big could it be? How much does the firm have of that market? That's what you're looking at. What part of the market do they have? Is that part of the market growing? Are they picking up market share? All those kind of things. That's the turnover piece. And then the margin piece is how profitable it is. So you got the scalability and you got the profitability. We tend to break up the margin side, gross and net margin, although like I'm talking, gross margins, a little bit of accounting imagery going on that you have to be concerned about. On turnover, I look at 3 things. One, really basic, and we had this in our screening model, is just revenue growth. What is our revenue growth? So Bloomberg has that factors to watch, FTW. And if you do that for each industry, usually 3-year sales growth is one of the top ones. So those factors are, here's the factors that have the highest correlation to how stocks have performed in this industry the last 5 years. And 3-year sales growth is usually one of the top. Sometimes it's 5-year sales growth. It kind of depends on the industry, but 3-year sales growth. That's a pretty easy thing to do, right? Just how fast have their revenues grown in the last 3 years. If you want to, you can definitely break that down into segments. Some of y'all have some pretty complicated firms to look at. So if you can break, now if you're doing a Disney, obviously you almost have to do that. You almost hope Disney doesn't come up on your list because it's pretty tough. Did Disney come up on y'all's buy list?
Yeah.
Yeah, that's a tough company to do, right? Because you can't just talk revenue growth. You have to break it down into the segments. So segments can be important. For Costco, I generally, it's the retail and it's the membership fee. You kind of keep it like that. I don't know if Walmart is getting into real estate and advertising, those other kind of things. You're seeing more and more non-Costco businesses in the Costco store. So maybe there's some real estate going on in there. Who knows? But try to find those segments. Capital IQ does a really good job on segments. Bloomberg does a really good job on segments. But you're stuck with whatever management gives you. So Costco, Capital IQ can't bring in more segments than what management supplies. Usually a capital management, boy, I'm going to mix up Costco and Capital IQ. So Capital IQ will generally break it up in business segments and geographic segments. Which do you use? It depends on the firm. Sometimes geography makes more sense. Sometimes you do both. You have to look through both. Costco is supposedly doing really well in China. You might want to look at that. So revenue growth, you may need to break that up. And then turnover versus capacity. Here, what you want to do is find what is the driver for revenue growth. We call that capacity. And then you want to do turnover in that capacity. For Walmart, I think it's pretty straightforward. Walmart, the main thing they do is they build more stores. Their capacity is square feet. How many square feet are they adding? And then I want to look at revenue per square foot. See if they're getting more business. Existing stores. So it's pretty straightforward. If I was doing Accenture, what would you think? What drives revenue for Accenture? What would they add so their revenues would go up?
Well, I mean, they're consulting for that.
Consulting firm.
Like passive, like market maybe. I don't know. They don't have a lot of.
Well, what would they add to add more revenue?
More
Employees, right? So if I were doing Accenture, I look at how many employees they're adding, and then what is their revenue per employee. At UTSA, we did revenue per employee. So a lot of service firms will do per employee. We always talked about with Goldman Sachs, it's not true anymore, but there was a point many years ago when Goldman was just killing all the other banks. For Goldman's net income per employee was better than other banks' revenue per employee. That's how profitable they were. They were just killing it. They're not quite there, although they're having a great year this year. What if I'm a hotel? I would probably do rooms, right? But what if it's a hotel that's franchising? A little more complicated, right? A little more difficult. What if I'm doing a cruise line? Cabins, right? So something from there.
They're like ranking, did they have else? No,
No, I don't hear it.
yeah, dude.
So you need to figure out that is on your firm. If it's a firm, one thing you can do, and I'll just show you real quickly. Sometimes property, plant, and equipment can be your thing to do. So what I'll do, we'll look at NVIDIA real quick. If you look at their balance sheet, NVIDIA's fixed assets are only 8 billion out of 110 billion. So revenue per property, plant, and equipment doesn't really make a lot of sense for a firm like that. But you look at Intel's property, plant, and equipment is 108 billion. It's over half. So if you have a firm whose property, plant, and equipment is around half or more of their assets revenue per property equipment can be a pretty decent thing to do. Firms that are heavy capital investors. So NVIDIA doesn't have a lot of investments. Intel has a lot. So revenue per property equipment can make a lot of sense. Airlines, we talked about airlines, available seat miles. You're really just looking at if every plane flew as much as it possibly could, and every seat was full, how much capacity they have. And you want to look at revenue for that. That's pretty important. I don't know with airlines, all those snacks they sell, which are so grossly overpriced. I don't know how expensive, their ancillary revenues are. There may be something there, but available seat miles. So every industry has their thing. Most service industries, it's employees. But again, Disney is a major pain on this because they don't have a lot of proper plant equipment. You can't use employees because of the theme parks. So Disney is one. I would have multiple ones. For the cruise lines, be one thing. Theme parks will probably be revenue for property plant equipment. On the production side, I don't really know, producing movies and those kind of things. So it's a little tough to do. But you're trying to figure out, are they getting better at that particular item? So if you look at Walmart, I'm going to use revenue per square foot. Their square feet have been flat over the last 10 years, but their revenue per square feet are up 3.93%. So they've gotten more revenue per square foot over time. Now, is that good? What would you expect this number to be just without any effort? You would think it would match inflation. You think it would just be up with inflation. So that's barely higher inflation. It doesn't look all that strong. It looks really strong the last 3 years. Look at that. Look at that growth, 450 to 615. So part of it is it's been flat for several years and then it's jumped up the last few years. So you have to look at that as well. Now, one thing to say on this, you want to look at the driver and its growth. You want to look at the revenue per that driver. You want to look at its growth. What you're trying to do is figure out, are they getting better at turnover? Now, you don't want to say, well, this one's higher than the other. It's really not which one's greater. It's possible they've increased their capacity 10%, but their revenue per that capacity grew 15%. That would be good. They add a lot of capacity, but they're still getting a lot of generation. It's possible the capacity go negative, but the revenue capacity jump up because they're closing down the least efficient of their stores or something like that. That can be a good thing. It's like when GM closed down in Europe. Why did they do that? Probably the profitability, but also some turnover. So there's a lot of combinations. When do you mention inflation? If I do revenue to square foot, I say it should be at least greater than equal to inflation. But if I do revenue to property, plant, and equipment, it should be greater or equal to 0. Why? Because revenue and property, plant, and equipment are in dollars. They're both in dollars, so there's no inflation there. But if you're doing revenue to something that's not dollars, like revenue per employee, revenue per hotel room, or whatever, then you say, man, you should at least keep up with inflation. But if you're doing dollar to dollar, then you just say, hey, 0 is good, any growth is good. So be careful, don't say, wow, the revenue per property, plant, equipment is not even keeping up with inflation. Well, both are rising with inflation, so you can't make that comment. This is a pretty important one that you do want to focus in on. With Walmart, it's not spectacular, but definitely with Walmart, you notice the last few years, there's Costco up there leading the way. You see with Walmart definitely improving quite a bit, but then so is the industry. But they are getting some improved revenue per square foot after being flat for a good, I don't know, 4 or 5 years in a row. Some improvement. So pretty important one. I given you on this spreadsheet, I gave you 4 of them, but you can easily add other ones if you can think of them and find them. So retail distribution, you can do it per store or per square foot. That's just the most obvious one to do. Any kind of consulting business per employee makes a lot of sense. We'll see next semester, we're going to do Energy, it can be proven reserves, pipeline miles, those kind of things that you can get and do some pretty good analysis on. All right, questions on that? They talk about this quite a bit in business breakdown is you're going to ask what drives the revenue growth of this firm and how well are they managing that? I remember a few years ago, Cisco Foods, they announced they were hiring all these new sales agents. And the revenue per employee dropped because they just hired them all. But boy, you're gonna be watching that number. You don't want to hire all these salespeople and they don't get the kick in revenue. So you'd be watching that pretty carefully. You hope it would be better than when they hired the people. And then the last one is just an asset turnover. That's just revenue to assets. You just want that to be higher, pretty straightforward. So you can look at the Walmart one, a section there. I talk about the growth in revenue. I talk about the capacity versus the growth in revenue per capacity, and then I give that graph and then do asset turnover. Asset turnover sometimes can be not applicable to some businesses because there's just not that much on the balance sheet. Like in NVIDIA, there's just not that much on the balance sheet. There may be a home office, but most of NVIDIA, and this is part of, we're out of time, I think almost, right? Don't let me go over 8:37. So, one of the issues you're gonna have with pharmaceuticals and NVIDIA and those type of firms where they have R&D, you do need to stop and think, where is the R&D going? What did your accounting classes teach you with R&D? Are they going to the income statement or are they putting it on the balance sheet? The answer is probably, it depends, right? So what is your firm doing? Where does R&D for NVIDIA go? You can find it in their financials, but you'd want to understand that. That's Intel. You'd want to understand that and find where it is. So research and development for pharmaceuticals, some of these tech firms, revenue for R&D can be pretty important. If I'm doing a pharmaceutical, I like revenue for research and development. But the challenge is the research and development they're doing today is going to produce revenues when? Maybe 3 years from now, 4 years from now. So it's a little bit tricky. But you agree for pharmaceutical, that's the revenue generator is research and development. It's the scientists. So, try to find where that's going on the balance sheet or income statement so that you're pulling the right numbers. All right, that gets us through revenue growth. And then bottom line, gross margins, net margins, pretty straightforward. Higher is better. How to do during versus the industry. Some of y'all are showing these charts on the industry analysis, just to show how profitable the industry is. So those are pretty straightforward. I use, I think, EBIT margin. I say net margin, I should say EBIT margin, but it's an EBIT margin. So we add back interest and taxes so you can just see without the debt side and without the interest, the tax side. So down here at the bottom, lines 44 to 52, the first two lines are asset turnover and net margin, and then I multiply those two together. But you have it there. You also have it up at the top. You have the gross margin there. With Walmart's gross margin, it has been much stronger in the past, and now it's come down to a lower level, probably because of Amazon. It got down to a really low level in 2022, and it has been recovering some since then. They used to be above 25 pretty consistently, dropped down close to 24. You might say big deal between 25 and 24, but 25 versus 24 is a huge deal for a retailer. So what's the margin for Microsoft? Gross margin for Microsoft. I bet it's not 25%. More like what, 80%? Kind of crazy numbers, right? So these are very industry specific types of numbers. So it is good to look at your gross margin versus the industry. You can see Walmart is right in line with the industry. My industry here, I can't remember what I pulled. I think there are some consumer discretionary in this number, so I don't think these are all consumer staple. These aren't all discount stores. I think Amazon's in there, so you can bring in another group of companies in there. You would assume Walmart would be in line or a little bit low, given that they are a discounter, and then the net margin slightly above the industry, in line. So pretty consistently above the industry. You can see they have definitely deteriorated and have stayed pretty flat, come up a little bit the last few years, but it has deteriorated from 5%. And going from 5% to 4% is a huge deal for retailer. Don't think of it as 1% change. 5% to 4%, that's a 20% drop in your margin. That's a pretty significant drop. And probably that is Amazon related, especially these years back here where Walmart was just really struggling keeping up with the online. So pretty straightforward. And then you can combine the two together, margin and net asset turnover and net margin, and you get asset turnover times net margin. Essentially, this is a return on assets, but before debt, before interest, and before taxes, what your return on assets. So that's the true growth of a business. That's where you want the firm that's selling. That's the most important thing management does, is revenue growth and profitability. You don't want to buy a firm because their tax accountants are really good. The debt side, you don't want a firm that's profitable just because they're borrowing a lot of money. You know, when does debt help you? Debt helps you, your ROE, as long as your cost of debt is lower than your return on assets. So any firm whose return on assets is higher than the cost of debt, adding debt just makes them look more profitable, but also leverages them, makes them more dangerous. So you really want, I actually think these are the most important lines. These three right here. That's where I mainly look for management to add value to the firm: asset turnover and net margin. You can see for Walmart, slight improvement over time on asset turnover, but a huge drop in net margin. So the return on assets has actually come down. But the last few years, pre-COVID, post-COVID, pretty impressive, right? Their margins are up 15%. Their asset turnover is up significantly. So don't just look at the beginning any number, look at the cycle. So Walmart, I mean, you look at Walmart stock, you can tell that Walmart has done really, really well. In fact, they've kind of beat Amazon at their own game. They're kind of hard, really, Target's really struggling, Kohl's is really struggling. So Walmart's doing pretty well, doing some impressive stuff. And you can see it in the numbers the last few years. So look over time and see how they're doing. But these three lines to me are the most critical for your firm, and to understand what's going on there. What is this firm doing to improve or deteriorate those numbers? All right, we'll stop it there. Next Tuesday, we'll finish this up and we'll start valuation, which is the more interesting part. We'll do ROE decomposition, and I'll show you how I did it, and I'll show you the formulas so it all works together.